Yeah. Hi, Kavya. Hi, Rajat.
Hi, Simon.
Yeah.
Hi, Stuart.
Hey, Rajat, how are you doing?
Good. How are you doing? Thanks a lot for taking the time. And thanks everyone for joining us today. Kavya, do you want to just quickly introduce?
Hi everybody. Good evening. Good morning, Stuart. I hope you're doing well. Uh, we as UTIF, UTIF along with Stuart from UFT and CSEL, we have planned a session for the startups under the CSET cohort, and now Stuart will take us along for the session, and Rajat is our entrepreneurship manager, and yeah.
I'll just give some context to you, Stuart. A lot of the startups in the cohort are basically in the process of moving from prototype to the market. I think maybe like the team has already shared with you. I would love for you guys joining the session today to maybe turn on your cameras, share your full presence with Stuart who's taking the time. And I mean, he'll obviously share more on the topic. We've already shared that with you. It's an important topic for a lot of you as you think about scale and going to the market. Like adopting this perspective early on gives you an edge on how you are going to build your teams, your products, and various other aspects of building your startup. So over to you, Stuart, for you to take the session today.
Great. Thanks, Rajat. And thanks everyone for having me here. I definitely appreciate it. It's great to connect with all of you. And I couldn't agree with Rajat more. As you might have seen in my profile, I have a venture capital background. And I find that so few entrepreneurs who are starting their journey into creating a business understand what a venture capital fund is, what motivates us, how we manage investments. And despite that, they still have accessing venture capital financing as one of their key goals for their company. So I always find that a little bit interesting. And that's why I've created this presentation to help educate entrepreneurs so they can understand, is venture capital a fit for my business? And if it is, what's the motivation? What's the thought process on the other side of the negotiation table in order for us to facilitate a transaction? So that's the essence of what my presentation is all about. So Rajat, can I just jump into it, or is there anything else you'd like to touch on?
Absolutely. Stage is yours.
Okay. So my lecturing presentation style can be my lecturing style can be collaborative if you want. So if you feel the need to ask a question or jump in while I'm presenting, feel free to write a message in the chat box or turn your microphone on and ask a question. That's perfectly fine. Or you can just sit back and enjoy the entertainment. So, okay, let's get started. I just want to make sure that we're able to see the shared screen because I can't see it on my view here.
Yeah, we can see it.
Awesome. Yeah. Okay, great. Okay, so let's get started. Okay, so how venture capitalists invest. Firstly, a little bit of background about myself so you know the context. Sorry, just 1 second. Okay, so just so you know the context of who's presenting to you today. My name is Stuart Browne. I'm the CEO of a company based in Toronto, Canada called Pycap. And it has a number of different functions. The two main ones is that firstly, it's a venture capital firm. We have about $20 million in assets under management and 18 companies in our portfolio. We're also registered with the Canadian federal government under a special immigration program called the Startup Visa Program. And we've been what's referred to as a designated entity for over 5 years. And we've helped many different entrepreneurs access permanent residency in Canada. We've also put them through our accelerator program, which is now 16 months. In addition to that, I'm on the investment committee of an Ontario government-backed venture capital fund. I believe there's about 350 million in assets under management. I'm a former MBA and Master of Finance instructor, adjunct professor actually at the Schulich School of Business, which is the business school of York University. And I've also been a sessional lecturer at the University of Toronto for the BBA program. And the courses I teach are related to private equity, venture capital, corporate finance, entrepreneurship. And so that's kind of like my academic, government, and investing background. But just to, again, add a little bit more context, I also have an entrepreneurial background as well. So in addition to being the one who started the entity Pycap, I'm also the co-founder and former chief financial officer for a company called ChargerQuest, which is an electric vehicle infrastructure company. When I was with the company, we raised over $4 million in equity financing. And we have over 100 connected, publicly accessible electric vehicle charging stations throughout, it says 5 provinces here, but I think it's now across 7 provinces in Canada. Okay, so let's just take it from the top. What is a venture capital fund? Like we all hear about, you got to get financing from a VC, but what the heck is this thing called a VC fund? Well, firstly, what's a fund? A fund is an investment pool. So essentially, you could look at it like a bucket where all of these people put money into the bucket. And then there's a fund manager who manages the bucket of capital and puts that into investment opportunities. So there's the fund manager, there's the bucket, which is the fund, and then the fund owns equity or a position, a security in other investments. So there's many different types of funds. There's hedge funds, there's mutual funds, there's ETFs, exchange traded funds. One of the things that makes a venture capital fund, or rather like the whole world of private equity, different from other types of funds or investment vehicles, predominantly is the fact that the fund managers get actively involved in the companies that they're investing into. So if you're managing a mutual fund, let's say you have $1 billion and you're investing in Tesla, Apple, all of these other types of businesses, SpaceX, whatever, you're not going to sit down with Tim Cook and Elon Musk and give them guidance on how to run their business. You're just basically a passive investor. Whereas in venture capital, you're an active investor. Of course, there's a lot of other things that makes venture capital unique. And venture capital, just so you know, falls under the umbrella of private equity. So there's different types of private equity funds like leveraged buyouts and distressed funds. Venture capital it is an entity that invests in equity, and it is investing in private companies. That's where the term private equity comes from. So when anybody is making an investment, there's a trade-off between the two pillars of finance and investing. Each pillar starts with an R. Does anyone know what I'm referring to? Risk and return. Anytime you make an investment, you're always weighing and balancing risk versus return. So you want the return, but the cost of that return is taking on risk. So if you invest in a treasury bill that's backed by the US government, the risk is quite low. But then again, the return is also going to be low. So as you kind of go up the scale of potential return, what comes along with it is increasing risk associated with that. And so the reason why I bring this up is because a venture capital's perspective is one that is looking at investment opportunities that are extremely risky. So why is there so much risk in the nature of investing that venture capitalists do? Like what makes an investment risky? Why is a startup considered one of the most riskiest investments you can make? Can anyone answer that question? Okay, so I gotta see if there's, could someone let me know if there's any messages coming in the chat? Okay, I have it open now, so I can check. All right. So one of the things that makes startups so risky to invest in is basically because, as the term implies, it's a startup. The company is starting brand new. So when a company is starting for the first time, it's lacking data. It's lacking a track record. Someone mentioned here a high failure rate. You're absolutely right. There's a massively high failure rate. In fact, it's often quoted that investing in a startup has a 90% chance of failing. So obviously that's quite a high level of risk. And the reason why it is so risky and has such a high failure rate is because when you're entering into a startup, you're always creating a company that has no track record, and you're often creating a product and possibly even a business model that has never existed before. So if you're going to invest in a company on the stock market and you're trying to predict where the share is going to go into the future, you want to look at indicators in terms of the past to kind of help give some sort of perspective in terms of where the share price can go. I mean, obviously, you're also looking at current events and trends and all these other things, but you want to look at the performance of the company. That's why investing in Apple is a lot safer than investing in some entrepreneur who's creating some AI platform and he's never created a company before. Because Apple has this long history of producing successful products, where the startup, you have no idea if it's going to be able to execute or not. They might have a plan on a product they're looking to create. You have no idea if they're even able to create the product. You don't know if they're going to get enough financing. There's just so many question marks. Every time there's a question mark, that should indicate additional levels of risk. Everything you look at as an investor always has that risk return trade-off. So I mentioned that we have this startup visa incubator program. So we help entrepreneurs come into Canada, get their permanent residency. A lot of times they ask me, oh, how can I get financing from a venture capitalist? And so I have to educate them and say, like, look, okay, you have a startup, you don't have a lot of traction in building your company. It's a brand new product, brand new business model. So inherently, there's all these other layers of risk. Now we're going to add more risk to it because you're coming from a different country that investors here are maybe not connected to and don't have any insight into from like a due diligence standpoint. And then on top of that, you're not sure if you're going to get your permanent residency. So there's the risk that they might not even be able to immigrate here. So it's just, see, everything is kind of layered on and from a risk standpoint. Jayton, question.
Yeah, hi Stuart.
Hi.
Just based on what you were saying, uh, for startups like us, we usually don't go for bank loans because we feel that bank is just going to give us the money. But when it comes to a VC or a private or an angel investor, these guys are gonna bring us network connections, a lot more thing rather than just bringing the finance in. But when it comes to companies like Apple, Google, Microsoft, you name it, these companies, they have their own expertise in all of those things. So they just require finance rather than they have their own network, they have trust. So I don't think they need to go for that. So in terms of for investors, like when you said investors will try to invest in Apple rather in startups, but these kinds of company don't usually give them a chance to bring themselves on board until unless they would have reached them at initial stage of where they have printed at least few iPhones launched in the market. But am I right? No, I said
No,
something
no,
wrong.
okay. Thanks for asking the question. And you know what? I like the feedback because it allows me to kind of tailor the presentation and refine it based on what's important to you and what the conversation goes and how I'm explaining it and the retention and that sort of thing. So just to add a little bit of clarity, I wasn't necessarily saying that investors are going to choose Apple over a startup. I'm just saying that I'm just trying to highlight that those are two very different investments and two very different perspectives on how to make a decision on if you should invest. So I'm just saying that, like, for example, Apple has a long track record and a startup has no track record. So a startup is way riskier. So the startup, and I'm kind of building up to a crescendo here, because the risk is so high, the return potential has to also be extremely high in the eyes of an investor in order for them to decide to invest in your company. So there's this constant trade-off that is going on in the investor's head when they're looking at you and you're presenting your company. They're asking themselves, okay, how risky is this? Like, what's the chances this company is going to fail? Like, what indicators, what evidence, what proof can they give me to show that they're not going to let the company fail? So that's one side. The other side is how big is the opportunity here? Like, if they are successful in executing the development of their product, bringing their product to market and doing all of these other amazing things, is the return potential significant enough to outweigh the huge amount of risk?
Right.
And then given that VCs are active investors, just as you pointed out, with connecting the entrepreneurs to networks and supporting the company, helping manage, that's another factor that goes into the decision making. So it's not a situation where a VC is looking at an entrepreneur and saying, this startup has to have everything figured out or else the risk is too high and we're not going to make an investment. It's more like, does this entrepreneur have the potential to be successful based on his own merits and what he is doing with his business, plus everything we could bring to the table? So it's almost, in a weird way, not necessarily a bad thing that a company doesn't have everything figured out, because if it did, it would kind of no longer be a startup, and then there wouldn't be the opportunity for a VC to invest and acquire a significant portion of equity and then help that company grow. So another kind of way to help all of you understand the type of investor that a VC is look at what terminology describes different types of investors. So if I'm going to invest in the stock market, like Warren Buffett. So Warren Buffett is known as a value investor. So when he looks at a share price, he asks himself, is the share price of this company undervalued? Like, are there external factors in the market that have impacted market psychology and they're selling off things unnecessarily and it's causing the share price to go down as opposed to the intrinsic value of the business? So the hope is that you invest in something when it's undervalued. So at some point it reaches equilibrium and becomes the price that it should be at. Venture capital is different. Venture capital, we're growth investors. So instead of trying to assess, is this undervalued or overvalued or fair valued, instead what we're doing is saying, can I grow this and increase the value actively so that when I sell my position or exit, will I generate a significant return? So that's kind of the sense of the risk return trade-off. So I'm trying to be careful not to kind of deviate into like a full lecture about finance and investing. So I'm gonna power through. But Jetin, thanks again for the question. Let's keep moving. Okay, so here's another. These are the three fundamental things I think of, and I believe most other VCs think of at the onset when an entrepreneur is pitching us. It's like the three fundamental kind of elements of a startup that we want to assess. Number one, can the company survive in the short term? So I'm clearly like a bit of a finance person. So I always kind of assess the company from the cash flow standpoint. Like I look at something like burn rate, runway, how much capital do they have currently? How much are they spending per month? How can we decrease the burn rate and extend the runway as much as possible? How fast is this company, whether we're putting money in or not, going to be able to survive until they start generating cash flow on their own? So that speaks to survivability. The second thing we look at is how much can this company grow within the medium term. So short term is about survivability. Medium term is about scale, exponential growth. Can it grow extremely fast and high to generate a sizable return to compensate that huge level of risk we discussed? And then in the long term, here's the third thing we look for. Can we exit this company? Does anyone know what I mean by exiting a company? Okay, good. I see people nodding their heads. It's great. So those are like the three things. And if any one of these things is missing, then the venture capitalist essentially is not doing their job. So oftentimes, I'll just touch on something quickly. Like I know a lot of entrepreneurs get frustrated because there's so many entrepreneurs out there trying to start a business. They're pitching VCs and they're looking at venture capitalists like, here's this guy or girl who's sitting on this huge mountain of capital, hundreds of millions of dollars. I'm a struggling entrepreneur. I have a great idea. Like, why can't you just invest in my company? Like, give me $100,000 or 500 grand. It's nothing to you. You're sitting on hundreds of millions. Like, your job is to help entrepreneurs. So that's like a very entrepreneurial kind of perspective, but you have to like understand the perspective of the VC because that's who you're selling your equity to. The VC, like, they are managing capital from other investors. We call them limited partners. So they're giving us their money. And so we have to be very careful to deploy the capital into investment opportunities that meet our fiduciary duty, so our agreement with the investors, number one. Secondly, of course, we need to make sure that the potential of our portfolio companies has a very high chance of success as much as we possibly can, because if we are not successful in managing this fund, the chances of us being able to raise the next fund is going to be a lot lower. Like, the investors will not believe in us to give us money. Kind of like if you're an entrepreneur and you raise money from an investor and your company goes bankrupt, the likelihood you could go back to that same entrepreneur for more financing for your next venture is obviously a lot less likely. So, okay, so we're going to look at like, again, how VCs analyze companies. So these are 5 things that we essentially look at. We want to look at the idea. This kind of speaks to the growth potential. Like, is it innovative? Does the technology, is the intellectual property unique enough and valuable enough that some entity in the future will want to acquire it? What stage of the development is the company at? So this is an important factor, because if you come to me and say, okay, I want to cure cancer, I might think, okay, wow, amazing market opportunity. Everyone's going to love this invention. But how far along are you within the development of your product, from the point where you're creating the product to the point that it's commercially viable? And so the closer you are to commercial viability, the less risk it is that you're going to be able to deliver on creating that product. If it's at the idea stage and it's this amazing, fantastical idea that could have massive potential, if you haven't started developing it yet, or if you're very early on in creating the product and I can't like demo it or use it, then of course that speaks to the level of risk, in the sense that I don't know if this team is able to actually create the product because it is so early on the development. The management team, you'll notice that all these little things that I'm talking about really all goes back to risk and return. That's why I started this presentation with that. And so that when you communicate your company to a venture capitalist or business partners or whomever, you could also kind of speak to those terms as well. Then you're kind of speaking the language of investing and finance. Okay, management team. So we talked about how when you create a new company or startup is just starting out, it's brand new, it doesn't have much of a track record, so the risk is very high. So kind of like a detective, a venture capitalist might say, okay, well, I really like this team. I really like this idea. It's a startup, the risk is really high. So what can I look at in terms of clues that could help bring down the level of risk and possibly even bring up the return potential? So even though that the company itself doesn't have a track record or experience or data to show that this business model has a good chance of being successful, what other clues can we look for? Well, in the management team, we could ask ourselves, okay, well, what background does each individual management team have? So if we look at someone on the team is a serial entrepreneur who has consistently like created and sold companies at a very high level of return in the past and is now on the team for this company, that's a very good indicator that the chances that they'll be able to do that again with this business that I'm considering investing in might happen. So that speaks to the return potential. And I'm not saying you can't be successful if you don't have that. You know, it's kind of like a basket approach. We assess all these different things and weigh it all out, and we say, okay, they're lacking in here, here, and here, but they have great things over there, so we'll make an investment. But when you're building out your company, whether you want venture capital financing or not, to make a successful business, you should be considering these things as well. So you don't have someone on your team who's a serial entrepreneur. Can you get someone on your team who has experience being successful in business? And by the way, I don't mean giving equity or paying someone. Maybe get them on board as an advisor just to start and see how it goes. Build a relationship, because if you have a pitch deck and you have all of these faces on there and you have like very successful entrepreneurs who are mentoring you, or maybe a venture capitalist who's on your team mentoring you as well, that's a really good indicator to the investor that you're going to be receiving the type of guidance that you need to weather the storm of making your company successful. Other things that we look for in the team is domain experience. So if you're creating a company that is a app for construction workers to use who are building houses, does anyone on the team have any domain expertise? Have they worked in that industry before? The closer you get to the customer you're selling to in terms of domain expertise on your team, the higher the chance that your product will be successful. Like if someone's on your team who formerly was working in the construction industry and said, look, I am not only a shareholder and manager of this business, but I also could be a customer, or I could have been. Like I am addressing specific pain points that I experienced as our current customers are experiencing, and it's being neglected. Nobody cares. Nobody's focusing on this. We are solving that problem. That's a lot more compelling than, okay, we just graduated from university. We have this great idea for this construction company. None of us on our team has ever worked in construction before. Again, I'm not saying you can't create a successful company without having someone without domain expertise, but you're increasing your chances of success if you have that. So if you're looking at your company right now and you're asking and you're telling yourself, okay, we don't really have someone on our team that has industry experience, then just try to get someone as an advisor to start off with. Like just start slow, build the relationship, unless you really know them well and you think it's a good fit for them to gain equity, but you have to assess that on your own. Other things in regards to management, there's some obvious things as well. Like if you're creating some new software involving artificial intelligence, Internet of Things, big data, all of that stuff, is there someone on your team who has that technical expertise to oversee the development of the product? If you don't have that, how can you get it? Okay, so, and then there's other things like marketing and marketing expertise, financial expertise, all of that stuff. Companies have failed because they have everything except for one component. Like there was a company that has, I know too many examples of companies that have raised millions and millions of dollars and it's just been completely squandered because some of these things are missing. Like the CEO had no financial expertise himself, and he wasn't able to get someone on the team with financial experience. So he had raised millions of dollars, and I think he was maybe not trusting of someone to manage the finances, or he wasn't being transparent. So he wasn't really able to get someone committing to him. And he squandered the cash, didn't know what he was doing, incurred a ridiculous amount of debt that he wasn't able to service. And then, of course, the company went bankrupt. Terrible situation. So that's another good point that I should remind all of you of. Like some entrepreneurs think the main goal at the top of the mountain is VC financing. Once I get to the top of the mountain and I finally get that capital in, there's going to be a VC that's just going to show me the way, and the company is just going to run off and become successful. That is not the case at all. Like you get money from an investor, like that's where the real work begins. Like if any, like I've raised money for companies, I've raised money for my VC fund. Like it's an amazing experience when you first get that money in. You can celebrate, crack open the champagne bottles, do whatever you want to do. But then the next morning, at least for me, that's like, oh my God, all of a sudden these people trusted me with my vision. Now I have to execute, because the last thing I want to do is make them think they made a bad choice by giving me money. I want to do the exact opposite. I want to surpass their expectations and give them an enormous return, give them an amazing experience, because obviously that will help you with your next venture or help you raise more capital for your current venture. Okay, so Strategic relationships, another thing that is a huge indicator of the company's ability to be successful. So I cannot emphasize this enough. So especially for startups, like I attribute a huge amount of my personal success just to strategic relationships. And let me explain how this works from a cash flow standpoint. Okay, so you're starting a company. Whether you raise a bit of money or not, you have very limited resources. And you also have very limited time to bring your company to a point where it's economically viable, where you're breaking even and you start generating cash flow. So with such limited resources, you're in this conundrum because you're like, okay, I created this product, and just because I created something amazing doesn't mean people are automatically going to be aware of it and want to buy it. Like I have to spend money to communicate that to the world and sell the product. These are like very real world problems. Another thing is when you bring your product to market, regardless of how amazing it is, like even if people know how amazing the product is, like there's a massive amount of trust building that needs to be implemented in order for a customer to say, okay, I am going to give money for this thing that I've never heard of before, and these people that I've never met before, and this brand that hasn't existed before. Like think of yourselves, like you're watching a YouTube video, an ad pops up for some tech thing. Maybe it's a crypto coin or whatever. You're not going to likely put money into something unless you've built some sort of relationship with that brand. You're familiar with that brand. So when it comes to strategic relationships, like, and you have all these limited resources, you don't have money to spend on salespeople and blow it on marketing and doing all these other things. Like you need to figure out a way to scale. Even if you spend it on salespeople and marketing, there's still that hurdle to surpass. Like, how do you build that inertia of getting your first customers in? So let me tell you the secret of success that I have experienced and many entrepreneurs have experienced. Distribution channel partners. It's the best thing you could possibly do. So you get someone, you essentially outsource the brand trust, the relationships, the distribution network to an entity that you could partner with. So you're giving value to them, they're giving their network and their customers to you. And you're able to kind of leapfrog over that issue of building your own network. So let me give a quick, okay, Rajat, I'll address your question. I'll just give a really quick example. So our company, ChargerQuest, the whole company was built on strategic relationships. So the company went in and we had raised $4 million. It's a decent little chunk of cash. It's not enough to execute on our vision, which is to have electric vehicle charging stations all over the country. So how did we get into 7 provinces and have like almost 200 charging stations? Well, it's because we didn't have enough money to buy the real estate. So what we did instead is we partnered with entities that already own the real estate, like a shopping mall, hotels, restaurants. And we basically said to them, let's form this partnership. Like we need access to your customers because we need the traffic coming in and using it. And in exchange, we'll give you a percentage of our revenue, and we will allow you to be seen as a environmentally friendly organization. And now you have this new amenity to offer your guests. So if somebody's driving down the street in an EV and their battery is getting low and they're thinking, oh, I have to go get something for lunch or dinner, or I have to go to a hotel. Like I drive a EV. So I am way more likely to go somewhere that has an electric vehicle charging station than I am that doesn't if my battery is low. So that's just an example of how we were able to scale using this very interesting strategy called strategic relationships and distribution channel partners. Okay, Rajat, question.
No, thanks. But I was actually going to ask for an example to illustrate the point, because I feel what you touched upon is an important point, and often like a lot of startups don't get access to examples that you mentioned.
Okay, yeah, no problem. I'll give another quick example then if needed. Okay, I said we're with this whole startup visa thing. You know what? I do marketing and stuff like that, but it's not really to sell the product. It's more just to update our stakeholders in regards to what our company Pycap is up to. But in reality, all of our companies, entrepreneurs from all over the world, like I don't have the bandwidth or even the budget to go to Brazil, Dubai, all over India, Thailand, China. I mean, I do go there, but I don't go there enough to warrant the kind of opportunities we've had in terms of getting entrepreneurs into our incubator. So how do we use strategic relationships? We have immigration law firms and consulting firms bringing us clients all the time. So we have like hundreds of applications coming in, and it's amazing because we're able to pick like the best entrepreneurs that have the best opportunity for the Canadian economy that we can. And we don't have to find them ourselves. Like they come to us basically through these different immigration providers. Okay, so next thing is market validation. So this is a big element. I'm kind of jumping ahead on slides, so I'm gonna get caught up here. Okay, market validation. So we talked about how a startup inherently has no track record or very little. Oftentimes it doesn't have sales. So how do we know that this thing that the entrepreneur is producing, there's going to be demand for it? Sometimes I educate aspiring entrepreneurs to almost look at their pitch presentation to an investor. They look at the pitch presentation to an investor kind of like they're building a case, like they're a litigation lawyer, and the VC is the judge. And the VC is trying to think, okay, is this a good investment? Is it not a good investment? I can't decide. And so, of course, the entrepreneur is going in front of the judge, VC, and saying, this is a good investment. Let me prove to you why that is. And then you have to come up with evidence to back up your theory that your company and you are a good entity to put money into. And so when you're speaking the language of VCs, again, as mentioned, you gotta look at that risk return trade-off. So you're always trying to say, like, look, this company has big return potential, and we're doing everything we can to mitigate the risk of failure. So market validation is a good example of this as well. So what do I mean by that? We look at it kind of like a pecking order of market validation. So market validation obviously is, have you validated the market? Does your customer segment want to buy from you? So of course, the best indicator of market validation, so when I'm thinking this pecking order, the number one thing obviously is revenue. If they're already buying from you, the chances they're going to buy from you again in the future after I put money in and they're going to buy more is the chances are a lot higher. Again, you have data to prove that they're already buying from you. Okay, so what if you're a startup and you have no revenue, you're pre-revenue? The next thing on the pecking order is, do you have a purchase order? So a purchase order is, I'm sure you know what a purchase order is, but let me put it into context for this example. It's a legally binding document that says when you provide the product to the customer, they are going to pay you. The next thing down from the purchase order is a letter of intent, LOI. So you kind of know where I'm going here. It's like high level of success with selling the product, and it just gets kind of less and less, more and more obscure as we kind of go down the pecking order. But I'm not saying it's not good. Like this is just what the order of operations that you have to follow, again, to build your evidence to prove to the VC in your case that you're a good investment opportunity. So a letter of intent, that is just obviously a letter with a customer. So it has to be someone who actually has buying power at an organization that is saying, and it's not a legal agreement like the purchase order, that's why it's in another rung down, that they have the intent to buy from you if you meet the specifications of the product you're looking to produce within this time frame and meets their due diligence. You know, you can make it very fluffy to the point where they really aren't obligating themselves to buy from you. They're just showing some level of indication by signing that document that you have had the conversation and they do have that interest. And remember, like all of these things that I'm telling you, like it's not a checklist where you just bring it to the VC and they're automatically going to invest. When I get pitched to by entrepreneurs, there's a level of due diligence that is required before we make an investment. So if you bring me a letter of intent and you say, we're producing this piece of furniture that Walmart is going to buy from us. Look, I got a signed letter of intent from Walmart. I'll say, oh, fantastic. Let me look at the letter of intent. The letter of intent was signed by a store greeter, not someone who actually can purchase the product. So that's another thing you always have to be cognizant of. Like things, you have to be transparent. It has to be real, because the due diligence period, if it's a sophisticated investor, is going to be sufficient enough that they're going to basically find out everything. So obviously be truthful, be transparent, be realistic. Okay, so we talked about exits. You mentioned, I saw a lot of nodding heads when I asked if you are familiar with what an exit is. So I'll just touch on this a little bit, because even with my Master of Finance class and my MBAs that I lecture, like they have brought presentations to me where their big solution for this company that's having issues is to exit, like get acquired, take the company public, have a secondary buyout. But then they can't explain why that is a good exit opportunity from the perspective of the person who is actually acquiring it. Remember, you always got to think of the person or the organization on the other side of the negotiation table. And you have to back up and prove literally every statement that you make or every claim when you're pitching to a VC. So if you are pitching a VC and you're telling the venture capitalists, look, see, I proved to you that we're going to survive in the short term. I have shown you this huge growth potential and how we're going to grow in the medium term. Now let me explain to you how we're going to exit. Because remember, if you don't have that exit as a venture capitalist, you're going to be in a paper-rich, cash-poor situation. It looks good on paper that you have this really valuable company in your portfolio, but if you can't actually take money out of that company, if you can't exit that company by selling your equity position within the time horizon of the fund, then you're not doing your job. You're not going to be able to get realized capital gains to your limited partners. And then again, you're not going to be a successful VC. So exit is critical. Yeah.
So I'm not sure if many of the participants also know, you mentioned the timeline of the fund, right? I don't think you've touched upon, maybe you want to touch a little bit upon that as well.
Okay, good point. Thanks for bringing that up. Yeah, you're right. I mean, we're obviously connecting for the first time here, so I don't know the background. So perfect. Thanks, Rajat. When I say time horizon of a venture capital fund, a VC fund, and I'm holding myself back because we only have 10 minutes left and I don't want to deviate into a finance lecture, but venture capital fund entities are very different than your standard corporation. In fact, the fund itself is not a corporation, it's a limited partnership. And just to cut to the chase, each fund, each limited partnership is a closed entity or closed fund. Don't worry about the terminology. All you need to know for this context is that it has a limited timeline. So funds are often 10 years in length. So all you need to know in that regards is to have a successful fund, you need to invest, grow, and exit all within that period of time. And you might be investing in few different years, and then you have to harvest those investments, grow them, and then exit them all within that lifetime of the fund. So if you look at funds like Sequoia, Andreessen Horowitz, Omer's Ventures in Canada, or even Pycap, will have like fund number 1, 2, 3, 4, 5, because they have these limited timelines. So when you're communicating your business and the potential to a VC, you also have to keep that in mind. And as a rule of thumb, as a venture capitalist, we look to invest in a company and have a 10x return, so grow it 10 times its current value within a period of 3 to 5 years. Because remember, we don't want to hold on to something for 10 years, because if we're investing in something that is year 4 and the company's going to exit 10 years later, then you've just surpassed the timeline, the time horizon of the VC fund. And then what happens at the end of the timeline is the limited partners sometimes will just get the equity transferred to them, and then the fund no longer exists. And then the investors are like, okay, what the heck do I do with this equity? I'm not the VC expert. I can't help them grow the business and find a buyer and all this other stuff. Okay, so let's go back to the strategic, like the different exits. So strategic acquisition usually happens vertically or horizontally. Horizontal is meaning you have a technology or product that you could sell to a competitor. Kind of like when YouTube was bought by Google. Google had Google Video, which was a competitor. YouTube had YouTube and a massive user base, all this content. And Google was thinking, okay, we already have the technology, instead of creating this following and going through all this problem to try to build this entity up, it's going to be easier and cheaper for us to just buy YouTube. So that's an example of like a horizontal thing. Vertical acquisition either happens where it's your supplier buying the company, or it's the customer buying the company. So I have my family business that my grandfather started. He was importing products from China. He had a supplier in Shenzhen, and they were distributing over like 30 countries all around the world. So when it was time for the family to exit the business, they were getting approached by private equity and different types of buyers, but it was actually the supplier in Shenzhen that bought this company so they could have access to all of these channels of distribution all over the world. Okay, so point being, why am I talking about this? Is because just saying I'm going to exit through a strategic acquisition to a VC is not good enough. You have to say, why might it be attractive to competitors, a customer, supplier, a strategic partner, who knows? But you have to go that extra mile to explain it to them. IPO, exactly the same thing. That this is probably something that frustrates a lot of my students early on when they hand me in assignments and they say, this company should just IPO. That's the solution to their capital problems. I'm like, okay, now you're done the presentation? Yes, now we're done. That's our big crescendo. I'm like, hold up a sec. Like, why? Explain to me why this company should IPO. Do you even know what an IPO means? So what the heck is an IPO? Initial public offering. You are taking shares in your business and you are, instead of offering it to private equity, remember private equity, you're now offering it publicly, i.e. initial public offering. You're offering your shares publicly on open stock exchanges like the Nikkei, the New York Stock Exchange, the Toronto Stock Exchange, et cetera, et cetera. Okay, great. So now we understand that. But just like you're trying to understand the VC investor and why they're investing in your company, why the heck would the public invest in your company? What kind of companies does the public invest in? Again, now you're exiting VC world and now you're entering into kind of more Warren Buffett world. What's another saying that Warren Buffett often says? only invest in what you know. Does the public know about this cybersecurity thing that, you know, is quantum computing and all this other stuff? Or is it something they could touch and feel and hold, like a Tesla vehicle or a Uber, or, you know, et cetera, something that they use, that they're familiar with. Okay, then there's the secondary buyout. That's where the venture capitalists will sell their position to a later stage investor. So you might have heard of like Series A, Series B, Series D. So Pycap, we invest in kind of the pre-Series A to Series A. So the companies are usually valued potentially at around $10 million. So we invest in them. So our expertise is kind of growing them through that early stage and getting them up that kind of value growth curve. Our expertise isn't necessarily bringing them to $1 billion. It's more like bringing them from 10 million to 100 million. So we would sell that hopefully to a strategic buyer, an IPO, but failing those two, maybe we could have an exit through a secondary buyout. It all depends on the strategy of the management team of the company, what their trajectory on how they're going to be raising money, their whole kind of pathway. Okay, so quick summary. Remember, always speak the language of VCs. You know, I really encourage you, even if you're looking for VC financing or not, look at your business from the lens of a venture capitalist. Because essentially we're thinking about the same thing. We want to invest in a company and make it successful. We want to assess a company and plug in wherever the gaps are to make it a massive success. And that's what you as well want to do, because you're a shareholder in your own company. Whether you have put money into your business or not, you're an investor in your company, because you've invested your time, your reputation, your network, your skills, your abilities, all the value, all those resources that you have, you're dumping it into this entity. That is your investment. So you should look at it from a standpoint of, how do we make this thing survive in the short term? How can we grow it in the medium term? And then if you want, and if it's a fit, how can we exit in the long term? All right, everyone. Thanks so much for being here. I know I open it up for questions along the way. We're now out of time. If there are some last minute questions you would like addressed, happy to spend an extra couple of minutes addressing that, or we can adjourn the seminar.
Yeah, thanks, Stuart. Open to the participants.
Yeah. Hi, Stuart.
Thanks,
Amon here.
So I wanted
Just
to ask
wanted
a
to
question.
clarify. Just
So
wanted to clarify the difference between a secondary buyout and a regular exit of a VC or a private firm. Isn't it the same? Secondary buyout, in my understanding, is from one VC to another VC. But isn't that also similar to an exit, or is there any legality difference which separates the two? Is it like
There's it is an exit, because if it's a secondary buyout, when I say exit, it kind of means like the company that we have in our portfolio is no longer in our portfolio. We've exited our position. And so by exiting our position, when we own equity in it, obviously it's in our portfolio. When we sell the equity, it is no longer in our portfolio. So whether we sell it to the public through an IPO, like we sell it on an open stock exchange, or we sell it from a tech company, for example, buying the competitor, or we sell it to a later stage VC or a private equity fund, it's still an exit, because we're still selling the equity to the next buyer. And as you touched on, the secondary buyout would be someone coming in, like a later stage VC or a private equity fund manager, who would buy the company from us, or buy our position at least from us.
okay?
Okay,
Thank you.
no problem. Any
That's
other
cool.
questions? Hi.
Yeah, I just had one question that which is the best stage to go to a VCs? Because initially we are working on early stage and we are in the prototype stage. So once that is done, is it better to go immediately or create some revenue, build some reputation in the market, and then approach a VC to scale up? So which is the best option to go to VC?
Okay, I'm really glad you asked that question. The trend of venture capital investing, at least very much so in Canada, is to take as much risk off the table as possible because there's so much uncertainty and volatility in the markets with AI and geopolitical stuff going on. So having said that, the later stage you can be at is the better. And having said that, I strongly urge all of you entrepreneurs to laser focus on generating cash flow and revenue. That should be the main thing that you look at, not VC financing, to be honest. Let the business model that you're developing and the product, the features, everything be dictated by the market. Like not by, what you expect VCs to want. Because when you start pitching to a VC, that's basically what they're going to be asking you. Like, prove to me that people want this. And when a VC invests, it's not a situation of like, let me put money in and we'll see what happens or we'll help this company. It's like you coming to me as an entrepreneur, you're saying, invest in my company. Let me show you how amazing our company is, but let me show you how more amazing it could be if you put money in, and we could double down, we could supersize what we're already doing. So you already kind of have to have that. So yeah, I focus on the revenue for sure.
Thank you.
No problem. Any other questions?
I don't see any hands up.
Okay, so if you're interested in learning more about Pycap, go onto our website. It's just www.pycap.com. And in the top right-hand corner, maybe I'll pull it up. Let's do another share screen here. So here's our website. If you want, just you could follow us on like social media and connect with me. Maybe you could send me messages if you think of some questions that you didn't get addressed during this session. So by clicking here, you could follow Pycap on LinkedIn, Instagram, and YouTube. Those are the main ones. We don't really use Facebook and X or Twitter that often. So all right, everyone. Thanks so much for attending today. Good luck with your entrepreneurial endeavors, and I hope to be in touch with you in the future.
Sure.
Yeah. Thank you, Stuart. Thank you.
Stuart.
Thanks a lot.
Thank you.
Thanks a lot for taking the time, and thank you everyone for joining us. Really appreciate you taking them through the fundamentals and also just like bringing in also all the important topics you did. If any of you learned something significant, valuable today, please let me know in your messages, and I'll rally that to Stuart to let him know, how the session landed for you guys. So he also knows what was the value that you guys received. Yeah.
Sounds great. All right, everyone. Have a great rest of your evening. All right. See you later. Bye.
Thank you. Have a good day, Stuart. Bye.
Thank you,
Bye.
Stuart.
Thank you.
Thank you.
Roger. Thanks.
Bye. Bye.
Bye.